Hey guys, this is Randy with the Right Side of the Chart. It is Friday, October 13th, 11 a.m. exactly as I'm starting this video, 11 a.m. Eastern Time. So the market's been trading for an hour and a half now. And time to do another video update since there's quite a few new developments in the market lately. For the first time in a while, we're starting to see volatility pick up. And I think that that moment I've been waiting for a very long time now, what seems like an eternity, is a breakout, a definitive break of the recent trading range, may be very close at hand here. All right, we'll start out here. I'm already on the 60-minute chart. I might as well start with that. Here's a story again, same story. This is that multi-month trading range that we've been in here, minus that brief whipsaw signal, that false breakdown back on September 12th, I believe it was. So that's where we're at. And all along, or at least for the majority of this, I've harped on the 116 level as my key support level. Yeah, that fake down there I thought was a real deal. And on that, I want to just continue to impress upon the theme that I've been harping on lately. I know all of you don't have time to watch the videos. I communicate my thoughts a little. I'm able to communicate them a little more in depth in there. And the theme that I've been harping on lately is the whole boy who cried wolf thing. I've talked for many months now about a likely correction in the market with these divergent highs building, this series of 3 consecutive divergent highs, and warning of a likely correction. Couple times it looked like it might be getting underway, and it never did. So rates, basically, to rehash, we've been in a pretty tight trading range following that post-Brexit dip and rip. And as I pointed out on Tuesday of this week, we had confirmation across the board on every major U.S. index had broken down below its uptrend lines, the primary uptrend lines on the daily chart, giving us the first solid sell signals in the market in a long time. I was sort of, I don't want to say lost in the 60-minute charts. I was keeping an eye out on the longer term charts, but it's basically stating this, that where we were back, in the last few weeks, nothing that would have happened on the daily charts would have made any difference until we finally came up on this trend line. We pinched up in this wedge and we've broken out. And again, I don't want to go over every single index because I've already put that up over the last few days in static charts and videos. And since then, yesterday was sort of a consolidation day. The bulls had an opportunity to kind of ramp it back up, take things, but maybe back up inside that channel. It didn't happen. Today we gapped down. Now this is significant somewhat because following both bullish breakouts to the upside and bearish breakdowns such as this, these gaps can be very powerful. What it does is my guess, and this is just my read on the market, my read on talking to other people, taking in what I can take in from the media, that there are a lot of doubters. I know there's just a huge percentage of people, traders, investors out there that think the Fed is omnipotent, meaning they can keep the markets as high as they want for as long as they want, that they have all the power to foil any breakdowns, bearish breakdowns. I've said all along I don't believe that to be the case. It's just the market dynamics. The market's been going up, and sure, I don't minimize the effect they have when they come out and they jawbone, which is most of what they've been doing the last few years or last year or so, is jawboning more so than actual action. But with that being said, trade the charts, and right now the charts show a clear breakdown. We had that consolidation day yesterday, and now we gap down. And what I was getting at here, what these gaps do, whether it's on a bullish breakout to the upside or a breakdown to the downside, is it tends to trap in longs who were dismissing this breakdown the other day, those who were bullish, and especially there was no follow through the following day, so they said, oh, I'll sit tight for now, and if we move any lower. And a gap, what it does, it causes a lot of pain because those long are now gap down and just hoping or waiting for, they're saying now at this point it appears that this breakdown is starting to get some traction. You can see the confirmation on the MACD with the MACD rolling over, bearish crossover, all the confirmed divergences, everything I've been talking about, impulsive price action, everything you want to see on a breakdown. And could this prove to be a false breakdown? Sure. Do I think it will be? No, I don't. Especially not at this point. But anything's possible. I'm going to get to the 60-minute charts and show you some things I'm looking at. There's just a little more work to be done to really help put the nail in the coffin and really firm up the intermediate to longer term bearish case. All right, so we have that gap, and not only does it really stick it to those who are long, because now they're just hoping for a bounce to get out, and usually it doesn't give them that option. It also does something else, and I've talked about this. This has been the theme in my recent videos, that whole boy who cried wolf thing. One day, the big bad wolf is going to come down and eat the sheep. And that means we're going to have a breakdown that sticks, and it's going to be the real deal. And if you, as in Aesop's fable, if you stop coming down, when the boy cried wolf, the villagers finally stopped coming because there was no wolf. The boy was just making that up. Well, if you are of that mindset and you just at some point here recently gave up on shorting, objective technical breakdowns, then that is what makes for a lasting top. And so you probably had a lot of traders here who would normally short, who have been shorting and have been burned quite a bit in the last few months, didn't take that signal. It wasn't, for whatever reason, maybe the breakdown wasn't impulsive enough. Maybe they're worried, as I said, that the Fed will come in and ramp things up, and they didn't see the follow through the next day. Now they're at a point where, wow, well, I really should have shorted here. This was the objective entry on the breakdown. I didn't do that. We had a back test yesterday. I pointed out on the 60-minute charts. That was another objective entry, but I still wasn't convinced enough. Now, however, the market's down over 1%. So to short here now, it's down 1% today, and it's also down from the break point, where it broke down. It's down almost, over 1.5%. And so I'll wait for a bounce. Those bounces don't always come. In fact, they often don't come. Just as on when you have a gap following an upside breakout, it usually leaves the wannabe longs behind, and it traps the shorts that didn't get out when they should have. And so that tends to provide the fuel for a more powerful sell-off in this case, or rally on the bullish side. So that's my take, and that's my read on the market. That's my read from experience. How things often work. And now let's take a look at the intraday charts and some important levels. Okay, forever and a day I've been harping on this 116 level as a very important level in the QQQs being what I consider the most important index, because that's where the strength has been, the leading names, the Amazons, the Googles, or Alphabet. All the leading tech names that are also big components of the S&P 500 as well. But the tech-heavy NASDAQ 100 has really led this market throughout the entire bull market, and even more recently, the only market to recently, or major index to break out to new highs. So this is the one when they kill the Qs, they've killed the market. That's my opinion. And this 116, even though we had that fake out there, I shared my thoughts before that I didn't think it was a bear trap, and I continue to focus on a break of this 116 level, and I still do. So far, look what's happened. Now maybe I'm wrong in the fact that we don't get that breakdown, but everything I'm seeing in the charts show we will. And regardless whether you agree with my analysis or not, you have to recognize how well that level has acted as support. We had that big gap down today, very impulsive move, the gap. So if this was one red candlestick from where we closed yesterday, it'd be from all the way up here at 117.45 down to those lows. And look at that bounce right off that level. Bounce, bounce, 2 consecutive candlesticks, another bounce. So far, a very muted reaction. And I often state, support levels, key support levels, will almost always, very often, more often than not, produce a reaction on their initial test from, if it's a support level, from their initial test from above. Likewise, if it's a key resistance level, the initial tag from below will produce a reaction. When I say initial, I know there were tags back here. That's what makes a level. I'm talking this level hasn't been visited in a while. So where I'm going with this, it's more than expected in my book that we have this reaction. And the important thing is, will this play out? When looking at this chart right here, what I see, these yellow lines right here, you can see this divergent high, prices making a higher high against all my trend and momentum indicators making lower lows. So this is negative divergence up right here at this point. Follow the crosshairs up. So we had a divergent high. I'll play devil's advocate because there's something I posted in pre-market this morning. Let's see if I can pull that up here for you. This is a chart of the NQ. The NQ is the E-mini futures, for those not familiar, the NASDAQ 100 E-minis. And what we have here, as I pointed out this morning, is bullish divergence. This is the MACD. You can see the MACD right here. I'll draw the divergence. This is the RSI, two of my favorite indicators. And so you have what appears to be a bullish falling wedge, a very clean bullish falling wedge. So for those of you bullish, if this thing breaks out and plays out as expected, what do I mean by that? Well, what I mean is the measured move. You have the target or measured move of a wedge. If you take the distance of the widest part of the wedge, which I've done here, I'd have to duplicate that line. I can't do it. I don't think I can with this screen draw software, so I'll just rough estimate it. Say you break out right here, then you're looking for a move, something like that, and that would then could very well backtest those broken uptrend lines on the daily charts that I talked about. It would show that the bulls defended that 116 level again. However, if this fails, that is extremely bearish in my opinion, because when I watched bullish chart patterns that fail to materialize, if prices just come right through here and these divergences are burned through, I think you'll see a big flood, a big wave of sell orders come in, an impulsive move down, as those trading the ES, those watching these charts, or the NQ in this, the ES looks the same. You'll see those traders exit that once the realization that the bullish chart pattern, this bullish falling wedge, did not play out. So there's still some work to be done. That wedge can go down. Prices could work their way down a little bit more as long as these divergences remain intact. So there's the bullish case. And again, we're at a battleground. This is my point. We're at also, while that wedge is forming, we're at support. Now, when you look at the 60-minute chart on the the Qs, which only trade during normal trading hours, you do not see that bullish or positive divergence. And these are the charts that I prefer to go off of. And most importantly, I've said this countless times, I always give a higher priority to the longer time frames. In other words, what I see on the 15 or 30-minute chart will supersede any bullish or bearish developments that I see on the 5-minute charts. Just as in this case, the daily charts are much more significant than the 60-minute charts. I'll use the 60 minutes to hone in and time my entries or exits, or maybe to confirm what I'm seeing on the daily charts. But right now, we have unmistakable, clear, impulsive breakdowns on all the U.S. indices, and we have powerful negative divergence on the daily time frame, where we have that bullish divergence only on the futures on the 60-minute charts, because the futures trade virtually around the clock. Now, there is some work to be done. Trend indicators, I want to see this 9 EMA right here, the white line, the signal line, cross below 0. That would indicate that the primary trend is now bearish. That's one thing we want to look at. And of course, as I said, that break of 116 on the Qs. Let's take a look at the SPY real quick. There's a SPY. We almost hit that minimum target that I've had for months now, 210.83. And just yesterday I pointed out, the back test of this triangle pattern here. We had this symmetrical triangle breakdown back test. That was an objective shorting op, and so far it's proved to be. But this is support. That target level you can see there, it's set there because that's actually a support level. So we need to see that get taken out. But so far, from the, to score a point for the bears, they have taken out the previous lows from the multi-month trading range in the SPY. This is a new multi-month low. We haven't been this low since going all the way back to early July. So that's pretty bearish there. And I don't see anything on the 60-minute chart on these price and momentum indicators and oscillators other than oversold, but oversold really isn't a buy signal, and we're not very deeply oversold. So there's a SPY. And then to wrap this video up, I'll just show you some of the other things I'm looking for to really help put the nail in the coffin and help firm up the bearish case. We'll go through just some of the top components of the cues. As I've mentioned for weeks now or months, there's been a consistent theme of deterioration in market breadth, particularly in the NASDAQ 100, which has been the leading index, has been taking the market, has been going to new highs. S&P 500 hasn't done that recently. And I pointed out, just like at the top in 2007, as well as with most market tops, you see fewer and fewer mega cap, the overloved, overowned names such as Amazon, such as Alphabet, Microsoft, Facebook. You see those names, which are they're the top weighted components of the NASDAQ 100. In fact, the top 10 components of the NASDAQ 100 make up or are responsible for over half the returns. So that's unhealthy. You're seeing it's great for those stocks, the mutual funds, the institutions, even I guess a good part of the retail investors are cramming into those names because those seem to be doing well. They're just putting their money what's working. But that is not a healthy sign of the stock market or the economy when the vast majority of stocks are not keeping up. And so we need to see, my point here is we need to see the leaders break. So what are we looking for there? Well, let's see. We recently had this little triangle breakout in Apple. And of course, that's, face value, that's bullish, and as long as it holds. But you can see there's quite a bit of support here in this range, at the bottom of that range. So let's look for a break below 112 in Apple. Alphabet, we'll clear that out. Alphabet, this is Class A, GOOGL, formerly known as Google. And this one has a very well-defined range. So this would be a big plus for the bearish case if and when Alphabet breaks below that 785, call it 785 level, the bottom of this trading range. In fact, that has the potential to put in an island cluster top. For those of you not familiar with island cluster tops, I would recommend to do a quick Google search. But an island cluster top is when you have a cluster of candlesticks, such as we do here, and that cluster of candlesticks is separated on both sides by a gap. So we have a big gap up here that's began that cluster. If in the next, let's say sometime next week, we gap below that island, this is your island cluster. Island cluster tops, from my experience, are one of the most reliable topping patterns. Likewise on bottom, I've gone long island bottoms, island cluster bottoms, which are the same thing. If you flip the chart upside down, after a prolonged downtrend, you have a cluster and then you have gaps on both sides. Those lead to powerful reversals. So not only is this pattern, from my experience, one of the most reliable topping patterns for a lasting top, a major top, it also offers one of the most objective shorting ops. And the reason being, if you short on a gap down, now you have the bottom of that island is resistance. And so let's just say, hypothetically, let me clean this up. Let's just say that the market closed here today right where we are. So although this is the bottom of the island right here, you'd have a gap right here. Imagine I missed it. Imagine I just cut the bottom of today's candlestick. So you gap down on Monday, let's say right here. You short. Now you place your stop. I would give it a little room above the bottom of the island in case they want to try to run the stops. So I would have my stop set just above the top of the gap that, the closing gap, or the closing candlestick, I should say, from the day before. So in this case, it would be Friday's closing candlestick if we gap down Monday. That loss is negligible compared to the amount of profit if this plays out as an island cluster top, because you're looking at a major trend reversal and probably a drop in Google measured well into the double digits. So That's what I'm looking at, and this seems to be a common theme among a lot of these leading tech stocks here. So we'll look at just a few more. There it is on Microsoft. This is a daily chart we're still on. We were just on a daily chart with Alphabet. Another potential there. And guys, even if we don't get that island cluster top, even if prices just limp on through there, the important thing is these support levels that I'm talking about here. See the orange line at 55.80? This defines this multi-month sideways trading range, and the winner or loser will be whichever way we break. If this breaks to the downside, more than likely that favors the bearish case, and not just for a quick trade, not just for a gap backfill. That's possible. There's a gap. That's certainly the first support level, but ultimately I think if we get a definitive breakdown, and again, look at the market as a collection of all its parts. Don't just trade Microsoft in a vacuum. If you short a gap down below this range, keep an eye on Apple, Google, or Alphabet, I'm sorry, Amazon, Facebook, and of course the broad markets themselves to confirm that entry. And likewise, if the bears can't take it down, they can't foil these ranges, or maybe they get this far and we bounce off the bottom there and we move back up and have an impulsive breakout to the upside, all the divergences that I just mentioned become burned through, then that certainly helps the bullish case. But right now, I think the markets are sitting on a cliff, the edge of a cliff. But there is that work to be done. We're not there yet. It's not an all-in short moment, like I like to call it, but it could be very soon. So these are things to watch for. There's Amazon. This is a chart I put up in the trading. I actually put it up in the 30-minute chart last week, last Wednesday when we were right here, stating that I think Amazon would see 806, this 806.34 level by the end of the week. Well, we made it halfway there. We actually made it about 60% of the way down. I measured it out with the fibs earlier. So unless we get a meltdown into the close, which is a possibility, I might be off on that, but that's a pretty bold call. This has been the strongest stock, I believe, in the entire NASDAQ 100. It's just been a juggernaut. And so far, the technicals are working. You had a bearish rising wedge pattern, negative divergence, trend indicators right here, flip to bearish, crossing below the zero line. Here's another trend indicator flipping to bearish. And Amazon's moving down just as you would expect after a wedge break. So and that's, again, one of the leading stocks that have been holding this market up in recent, well, for a long time now. And you can see big divergences on the daily chart as well. And even the weekly chart screams, major correction to me. This is the weekly chart of Amazon. Strong negative, clear negative divergences, a rising wedge pattern. And this is where I think, before all is said and done, I call it a high probability target zone. I think that's a good shot that within the next, who knows, 6 months to a year, let's say, that Amazon will see that level. And you're talking, having one of the world's largest companies chopped in half almost. That's the call. And there's a potential long-term target if things play out the way that I think they might in the next couple of years here. So, all right, we'll end it there. The story is the same. Just watch all these levels. Each of these stocks have their own levels, but those are the leading. Somehow I flipped over to the Spiders ETF. I should have been on the QQQ, looking at the QQQ components. But they're also, as I mentioned, there's a lot of overlap. Many of the top components of the QQQ are also the top components of the SPY or S&P 500. All right, we'll leave it there, guys. Those are the levels to watch. And, as I said, just be on guard, be ready, because from such tight trading ranges, often come some of the most powerful and lucrative trends to trade. So there's quite a few short trade ideas on the site. I have to clean up some of the longs that are on there that are already stopped out. And, if I see any standout long setups, I'll certainly be quick to share those on the site as well. All right, this has been Randy Finney with the right side of the chart. And as always, if you enjoyed the video, please do me a favor and give it a thumbs up on YouTube. Thank you.